Very often these volatile markets and sell-offs tend to feed on themselves, but certainly on a fundamental basis, there are a lot of investors with cash on the sidelines looking at securities that just in a period of days have all of a sudden become much more reasonably valued than what they were a short week ago.
Welcome back. We're talking about the recent fluctuations in the stock market. Joining us from London is Alastair McCaig. He's a market strategist with the investment firm IG. With us from Ithaca, New York, is Cornell University professor Andrew Karolyi. And here in our Washington, D.C. studio is Yukon Huang. He's a senior associate with the Asia program at the Carnegie Endowment for International Peace. Let's go to Alastair in London. Alastair, we just heard there from Leo Grohowski, who's Chief Investment Officer at BNY Mellon Wealth Management, saying that, look, yes, stocks have fallen in value, but doesn't this offer investors an opportunity? People should now get into the market.
Well, yeah, that's always one of the calls. I mean, I think looking at an equity exchange that falls away by 30 to 40% over a period of time, it does raise the question as to where fair value is on many of these equities. And again, I draw us back to a previous point I made in regards to the proportion of retail clients that are involved in the Shanghai Composite is disproportionately larger than in other equity markets. And on the back of that, there is a little bit more of an over-exaggeration in market moves. This is part of the reason we see so much more volatility in the Chinese equity markets, is because of the emotional aspects. Therefore, any corrections on the downside do arguably offer that little bit more attractiveness as far as lower pricing is concerned.
Andrew, what is Wall Street's role in this been? I mean, we've been talking about the volatility in Chinese markets, but to what extent has Wall Street contributed to that?
Well, it's an interesting perspective because of the fact that this is a symmetric integrated economic and financial market relationship that we're talking about between the U.S., Europe, and China. And in that sense, it's natural and sensible and logical that shocks that emanate from one segment of the market, say China, for whatever reason, would be something that spills over to another market. That's a reflection of a very healthy integrated market. What responsibility do they have? I don't know that it's a responsibility. These are market agents who are acting in their own interest. They are naturally going to be responding to the opportunities that are presented them through the flows, the slowness of the flows, the rapid flows, the unusually large spikes in one direction or another. I don't think of it as a responsibility. It's just sort of a natural, it's a natural organic relationship, and opportunities are presented and they react to them.
If I could maybe jump in here in regards to the way the markets have behaved, I think it's worth, again, remembering some of the sort of Western exposure that might maybe have emanated into the Shanghai Composite in regards to the unorthodox tactics that the Chinese regulators have tried to utilize in order to try and regain stability. Prior to the interest rate cut and the reserve ratio cut, there was much more a lack of a free market mentality in some of their actions. And I think maybe arguably that as much as anything else has played its part. I think you put up a decent argument to say, arguably, that the US, and specifically we'd look at maybe FOMC voting member William Dudley and his comments from earlier in the week might have brought about a little bit more of a correction in the markets rather than anything else.
Yukon, you want to respond to that? Lack of a free, I'll come to you in a moment, Andrew. Lack of a free market mentality?
Well, the Chinese economy has become more market-oriented over time, but it's still not fully there. We have to realize that in China, you have a tremendous pile of savings. China saves 50% of its income. Households save anywhere from 25 to 30% of their disposable salaries. There's a pool of money in China. It's been going into property. It's been parked in savings accounts. It's been going overseas. Equity markets is, in fact, what's been happening over the last year or so.
Andrew, you wanted to say something?
Well, I just wanted to jump in because Alastair made a very good point about the role of Mr. Dudley and the impending actions that will be taken by the Federal Open Market Committee here in the United States. What's ironic and something that we didn't necessarily see 2 years ago when there was this whole taper experiment, the announcement of the taper of the quantitative easing program. What we're seeing now is that regulatory officials in the United States are well aware of the potential consequences of their actions, not just for their own economies and for their own markets, but to those of others. That experience back in May and June of 2013 reminds us of this. And I think you're going to see even more discussion about this in September or the following FOMC meetings about the potential ramifications to countries like China. So if we have seen a burst of volatility now, it may subside now in the immediate short term, it's likely to come back once again, and quite possibly even larger so when that change of policy takes place in the fall.
Alastair, let's look at some of the other factors that may be contributing to volatility. I mean, we're looking at declining oil prices, the U.S. getting ready to put up interest rates, the U.S. economy still in recovery after 2008, turmoil in the Middle East, with ISIS on the offensive. I mean, there's many other factors, but these factors that I've mentioned, how much do they contribute to this volatility in the equity markets?
Well, yeah, just sticking with the FOMC and their interest rate rising actions for the time being before we move on to, say, oil and others, it's worth remembering that we've got a number of different countries in the Asian region, globally in fact, that have themselves pegged to the US dollar. So the actions that the FOMC take in regards to changing their interest rates have quite a significant impact on the Asian arena as well. Not necessarily China per se, but in a lot of the slightly smaller countries dotted around them. So that will have implications there. As far as the oil market is concerned, there's a lot of volatility there, and there's a lot of uncertainty as well. We've obviously had considerable progress as far as negotiations with Iran are concerned, and the reintegrations of them back into sort of the Western trading community, and the likely increase to supply as far as their oil reserves are concerned. And we've got to remember that they are would be one of the larger contributors to oil supply on the global arena. And we've only recently heard from Saudi Arabia some of the fiscal costs of their strategies that they've been implementing in regards to trying to keep the oil price as low as it currently has. $20 billion was a figure bandied about, certainly not small change, and it does raise the question, I guess, as to how long they can sustain this. Throw into the mix as well the fact that we've heard from Venezuela calling for an emergency OPEC meeting to discuss the supply of oil to the markets in regards specifically to the low prices. I think there's quite a bit of uncertainty as far as oil prices are concerned, pretty low levels at the moment. I know a number of the fracking supplies over in the US and globally have been affected by their unviability, but I think we're going to maybe see some of that oversupply, certainly in the short term, maybe cease for the time being.
Right, and Andrew, as you pointed out just a moment ago, we could see more uncertainty in the equity markets down the road. But something has changed right now. We're seeing something of a rally, as I pointed out, on the markets. What's changed?
You're tempted to say that it might be something to do with sentiment, and I'm not so sure. I think if you look from the long view, take a long view on all of this, what we naturally have seen over time in markets around the world for decades is that volatility spikes arise and then they subside. That is just sort of the natural course of events. And we're in this phase where there is this natural subsiding of volatility. But I think what one wants to look at is more of the secular forces at work, the longer-term, deeper forces. I think you and Alastair put your finger on it. The irony is sort of the media attention shifted to the role of China in stoking global financial market volatility, but the geopolitical factors have always been there, sort of lying at the core and driving a lot of this. And I would say on top of all of this, not just within the context of commodity markets, but in general, the emerging market space has grown in its importance and its profile and its relevance before global investors like never before. And we're seeing some very interesting and dramatic shifts in the flows in the last couple of months out of these emerging markets that are no doubt reflecting not just China and the spillovers from China, but also these geopolitical forces and the commodity market forces as well.
Yukon, question is, what do investors do now? Where do they put their money?
What's the problem? There's a global glut of savings. There's inadequate demand. Basically, those who have money are chasing yields. I think this requires a little bit of patience. The cycle's turning in the United States. I think China's going to level off. The slowdown is going to hit a bottom and then slowly rebound. I think Europe will eventually recover. Emerging markets have been going through a very difficult time over the last year. I think that also will survive. China has a core strength. Its consumption has remained relatively stable and strong. The service sector is getting actually larger vis-a-vis industry. Cycles are going to moderate. So in some sense, you need a little bit of patience right now.
And that's where we are going to have to leave it. Thanks to all of you for joining us.